Hello and welcome. We are on the 22nd edition of our consumer education series, Nivesh Kar Befikar, presented to you by Policybazaar. I'm Apeksha Mishra, your host for today's webinar, and we have some very senior experts, as you've already seen, joining us on the show today. So let's get started. Quick intro. So I would like to say that when the stock market is bullish and the share prices of different securities are appreciating in value, investing may seem easy and we are all keen, right? But wait, don't lose yourself given the sense of exuberance all around. You never know where the market is headed the very next moment. I am sure even after doing all our homework, there are some questions that still remain unanswered. Like, is the market going to rise further or is it going to fall? And should we be skeptic and wait for a correction, or should we cheer up and invest right away? There's always a few hiccups on the way. To help you understand what is the right time to invest in and what are the right kind of products that one should look at, today we have with us industry veterans, if I may say, Mr. Harshad Patil, Chief Investment Officer, Tata AIA Life Insurance Company. Accompanying him is Santosh Agarwal, our Chief Business Officer, Life Insurance, Policybazaar.com. Welcome to the webinar, everyone.
Thank you, Apeksha.
Thank you, Apeksha.
Right. Let's start with a very relevant question here, Mr. Patil. The market is currently at an all-time high. Do you believe this is here to stay? And also, can you take us through a quick, brief overview of the fund performances? Over to you, Mr. Patil.
Let's talk about Nifty 50. It started in 1997 at 1000, and there were so many market highs during this time period. But if you would have booked a profit at any point of time at the market high, you would have missed all this rally through this period. So if you would have invested at 1000 index in 1997, your money would have been 16 times now, plus whatever dividend yield that you have got over the period. So there's nothing like market volatility. Or nothing like timing the volatility. You have to keep invested and enjoy the power of compounding over the period. Now, I would like to take this opportunity to share our unit-linked fund performance. Now, generally, investors have a query that insurance don't offer those many options to invest. But here I'm sharing a list of funds which shows you that we offer quite diverse investment opportunities. So there is a mid-cap fund, there are 2 large-cap funds, there are 3 multi-cap funds, then there are 2 balance funds and 1 income fund. So clearly we offer quite diverse funds. Also, people have a doubt that do funds perform during this period, or is it difficult to generate alpha? Now, if you look at the fund performance, we have beaten the benchmark by 12% per annum in many of the funds. So, and all the funds have outperformed the benchmark index. So clearly there are opportunities to generate alpha, and you should be investing in actively managed funds. Then thirdly, Morningstar is an internationally recognized rating agency that rates funds, and they also rate insurance funds in India. And they rate top 10% funds as 5-star and next 22.5% funds as 4-star. And I'm pretty happy to share with you that 99% of our funds are rated either 4 or 5-star by Morningstar over 5 years period. So that is our fund performance, and so clearly we offer superior fund performance, and our ULIPs and ILPs clearly offer diversity and a life cover. So please go ahead and invest in our ULIPs.
All right. So just one more question before we move on to Ms. Santosh, and you can just answer it in a 2-3 liner. What is your advice to customers at the moment? Should they wait for market corrections or should they invest right away? Just a 2-3 snippet. What would you like to say?
Don't try to time the market. Stick to your asset allocation and keep rebalancing the asset allocation, so that helps you in profit booking and rebalancing.
All right. Moving on, now that we know that the markets are bullish, Santosh is here to take us through some of her recommendations for risk-averse or new investors, if I may say, and how Policybazaar is positioned to assist you all. Over to you, Santosh. Please help us understand the same.
Like I think Mr. Patil mentioned, that timing the market may not be the smartest thing to do, especially for beginners and first-time retail investors. The strategy to stay invested in the market is invest for the long term. Keep a horizon of at least 10-15 years in mind and stay put. And once you do that, trust me, if you pick up any 10 years of the market, you would not see your returns be negative. So that's the first point of if you are dabbling into equity, stay invested for at least 10 to 15 years. And it will also give you a sense of discipline. It will also give you a decent corpus at the end of the investment period, which can then fulfill an objective of a size like buying a house or your child's education. So keep an objective in mind and plan 10-15 years ahead and then invest.
Thank you, Santosh. So if you have more questions, please keep posting them. We are taking them live right now. Now that we have discussed the long term and short term, what is the minimum time frame one must stay invested in order to ensure good returns? What is your advice on this?
The power of compounding plays, and your wealth multiplies when you invest for longer term. But if you are looking for an insurance product, then I would say that minimum 10 to 15 years is the time period that you should look at. More the better. And equity investments beyond ULIPs also, if you're looking at, you should at least have a time horizon of 5 years, not below that, because you would get caught in the wrong cycle and lose money if you have a lower horizon.
Now that you've spoken of equity, my next question to you, Harshad, is since the market is on all-time high and we have been discussing this for a long time now, will it not be suggested to switch funds from 100% equity to debt in order to book profits? What would you like to say on that?
It is very difficult to time the market. So what each person should do is, based on his risk profile, arrive at an asset allocation. There are wealth advisors who advise you. And so for example, my risk profile would be such that I have a 50% equity and 50% fixed income allocation. That is my standard asset allocation that I arrive at based on my risk profile. What I should do is I should stick with this and rebalance it on a periodic interval. So maybe a year's time. So what happens is, if equities perform well, my asset allocation in equity increases beyond 50%. At the end of the year, I would book profit and shift that equity portion to a fixed income. Similarly, if markets correct, my equity investments comes down. So at that point of time, I can divest some of my debt portion and invest in an equity. So that helps you in profit booking also, and it helps you in adjusting your asset allocation in line with your risk appetite.
Moving on to you, Santosh. Now, you spoke a lot about the tax benefit one makes and all the other benefits. But speaking specifically of tax, we also have a question from Shivani. She wants to understand what is the maximum tax benefit one can get while investing. Any scheme that provides this maximum tax benefit, or any plan basically?
See, the maximum tax benefit basically means that you don't have to pay tax, right? That can be the maximum tax benefit. And when you invest, like I said, through any insurance product, you have to see that at least the entire corpus, the profit that you book, that entire corpus is tax-free under Section 1010D. The only thing that you need to keep in mind is that your life cover amount should be 10 times your annual premium. That's one thing that you should keep in mind. Some single pay policies where you're investing at one go, and where the life cover is not 10 times, the life cover may be 1.25 times. There this advantage does not exist. So just keep that in mind, that your life cover should be 10 times. And if it is 10 times and above, then you will get the 1010D benefit, where entire profit that you book through that investment is tax-free. And along with that, the premiums that you pay, on that you can get a tax exemption under Section 80C, up to 1.5 lakh rupees every year. So I think that is the insurance one product where, from a tax perspective, it's extremely efficient and continues to be superior most from a tax saving perspective.
Moving on, we have next question from Sam, and this is for you, Santosh, and he's live with us. He says, "Hi, I'm an NRI and would like to invest in single payment on an annual basis on a capital guarantee investment for 15 years to 20 years. How will the tax be deducted annually in this case, or payout time be? Will it be deducted by you or the investor is liable to disclose this?
Yeah, so you can take a capital guarantee plan where you invest once every year. When you invest once every year, for example, let's take a very simple example. You choose to invest, say, 1 lakh rupees every year, annually. You will invest for 15 years, say 15 lakh rupees. That's the investment amount. And you will get your maturity, after 15 years. So the amount of tax that you will save will be the entire amount that you invest, because you're investing only 1 lakh rupee. Here you can take tax exemption under section 80C on the entire 1 lakh. Plus, if 15 lakh rupees in the 15 years gives you a corpus, for example, say of 50 lakh, you've invested 1 lakh for 15 years, you've invested 15 lakh, and the markets performed well. After 15 years, at the end of 15 years, you get about, say, 50 lakh rupees. Now, the entire 50 lakh rupees will be tax-free, like I mentioned, through a capital guarantee solution. So that's how your tax, I would say, will play out.
All right, absolutely. Santosh, we have a question from Lona here, and that we spoke about FD rates and the return rates that we get. Can you help us elaborate? Lona wants to know, how are the rates better in these plans than FD?
See, now fixed deposits today, the example that we've taken, fixed deposits today for large banks, whether public sector or private sector, they're giving you return close to about, in the range of, say, 5.4 to about 5.86%, right? 6% is actually not, only a small bank may be able to give you that return. Actually, 5.5 is likely the rate of return that you'll get on a fixed deposit. Guaranteed return plans, on the other hand, there is a range. There are plans that will give you 4.5%, but there are plans that will also give you 5.8% or 5.9%. And these plans are doing extremely well. A large number of investors over the last 1.5 years have parked their money into these plans because the rate of return itself is better than an FD. And that's just, like I said, the starting point. After investment, the amount of money that you make, the corpus that you make through these plans, because the entire corpus is, say, tax-free, actually 5.85 can become, a 9% for somebody who is in the 30% tax bracket, for example. So that is how you will calculate, the rate of return on an instrument of this nature versus a fixed deposit where the profit will be taxable.
Absolutely. And now that you've spoken about performance, up till date, which one would you say is the best performing capital guarantee plan with highest returns that one should go for?
So I would say that when you look at capital guarantee plans, you should know that these are a combination of two products. One is a traditional non-participating guaranteed plan, and one is a market-linked plan. These two plans are combined to give you a capital guarantee. Now, the non-par plan, the fixed rate of return is known to you upfront. The other component, which is market-linked, there the money is being invested in the market, right? And depending on how a company is managing your money, the rate of return can differ. What you can today, say which company is better or which fund is better, is by looking at how that company has performed in the last 5 years, 7 years, or the last 1 year. So one can only give you a view of how the fund has been performing in the past. And when you look at that, then some of the names that come to your mind are companies like Tata AIA, who have very, very superior, who have demonstrated an extremely high, I would say, market performance, and consistently for the last 5 or 7 years in the insurance industry. There are other plans. There is also, I would say, HDFC Life, ICICI Prudential, and some of the others are, say, Bajaj. These companies also give you capital guarantee solutions. Their returns are also decent, slightly lower than Tata, but again, I would say are within the top 4. So you could look at say, Tata AIA, you could look at HDFC Life's products, you could look at ICICI Prudential, or you could look at Bajaj Life. All of these companies have given superior performance over the past, and hopefully will also be replicated in the future.
Absolutely. And now that we spoke about Tata AI and we have our guest as well, my next question was to you, Harshad. And we also have the question from Gagan Prakash in the audience here today. We want to know how Tata AIA Life is able to give a relatively higher guaranteed return, whereas no debt instrument in the market is giving that.
Yeah, good question, Apeksha. And see, actually, in this non-par, the tricky part is that we have to provide guarantee on the renewal premiums also. So 3 years ago, we had a feedback from the field that there is a great demand for this product, and we worked with a few of the foreign banks and came up with a hedging solution to hedge this future premiums that we get. So we predominantly invest in 3 assets here. One is government securities, second is AAA bonds, and third is this forward rate agreements that we have designed. So government securities, because of the upward sloping of the yield curve, the 30 and 40-year paper is trading at a significantly high levels than the 10-year government security. And AAA bonds that we invest in, since the inception of this company, we have not seen a single default. So we don't budget for that credit risk in pricing the product, and that offers an attractive return to our policyholders. And third is this forward rate agreement that we have designed. Because of the upward sloping yield curve, again, they offer a better return over the government securities also. So that is how we are able to generate that return, which is attractive for the policyholder.
I have another question, and since we were discussing the long-term and short-term, Harshad, this is from Aditya. He wants to know a basic question basically. What is the difference between a long-term and a short-term investment? And how does it work on parameters of risk or rate of interest or etc.?
Less than 3 years is a short-term, and beyond 3 years is 3 to 10 years is medium, and then beyond 10 years is long-term. So for an investor, if you're looking at any investment opportunity, generally for short-term, you should invest in short-term funds. When you have a medium-term horizon, look at a balanced fund, because the equity volatility would be reduced by the debt returns. And when you're looking at long-term, then it should be pure equity funds also, because then the cycle gets evened out, and over the longer period of time, you can generate significant returns.
There's a lot of details that Mr. Patil has shared all about Tata AI plans and all the other details. You can write in to us and also reach out to them in case you want more details and any help on that front. Moving on, Santosh, I have a question for you, and it's from Dinesh. He says, is there any tax on maximum 2.5 lakh investment per year in ULIP policy? Do we have to pay any tax if we do partial withdrawal in ULIP policies?
In the last budget, there was tax introduced for investment if you invested through a ULIP plan. For investments beyond 2.5 lakh, there is a tax implication, and you have to pay a long-term capital gain tax if the investment amount is beyond 2.5 lakh. So any amount beyond 2.5, the surplus, for example, if you invest say 5 lakh, the amount beyond 2.5, which is again 2.5 lakh, and that you will have to pay taxes. So that has been introduced in the recent the last budget. However, I would say that you should take into account the fact that the first 2.5 lakh rupees is exempt and tax-free, and calculate on the entire maturity, calculate how much would be the tax burden through this instrument versus some other asset class, and then take a call.
That's the main message here. Santosh, we have another question for you from Harinder. He's based out of US, and he's an Indian citizen but working in the US. He's to ask, should I invest in Indian markets such as insurance, stock, mutual funds, bond, etc.? The
Indian economy is still doing relatively well as compared to some of the other markets, and we see a huge inflow of foreign money today, even today in India, because of the fact that the markets have been consistently performing, and investors have been able to make money by investing here, and that continues. Some of the, I would say, insurance companies have got listed in the recent past, and you've seen that those companies have also really, I would say, shown exemplary performance. So if you want to invest in insurance based stocks or financial or banks, I think I would say they're in a position to give you very decent rate of return, because there is huge headroom for growth still. The industry is still nascent. The insurance penetration, especially in India, is still very low, and that gives you a huge opportunity for future growth. And hence, I would say it may not, be a bad idea to look at some of the insurance stocks available.
One last question, Santosh, and we'll take quickly concluding remarks from with the guests here. This is from Sidesh, and he says, I'm looking to invest 25 to 50 lakh INR for next 5-year minimum. What are the options I have to maximize growth, and should money be invested at one time or on a returning basis?
If you're looking to invest, say for 5 years, and you can either take your money at the end of 5 year by investing through a ULIP. When you invest through a ULIP, just remember the entire money is invested in the market, and at the end of 5 year, you will be able to withdraw your entire amount, or you can also choose a policy term of 5 years. Some ULIP plans give you that option. The alternative is investing through a capital guarantee solution, where you can invest for, say, 5 years, and you can get your maturity in 10 years. So you'll have to invest for 5, but stay invested for 10 years. That will ensure that your capital is protected, and also the fact that if you're invested for 10 years, the rate of return is likely to be better, or I would say less riskier. The volatility will be lower, and hence it may be a better idea to invest, pay for 5 years, but stay invested for 10 years through a capital guarantee solution. That kind of takes care of the fact that you will get market-leading returns. At the same time, your money is protected. The investment amount is protected.
Absolutely. Quickly, Mr. Patil, some concluding remarks from your end, a message to the viewers out here listening to us, and also we'll be putting out this session on our social media channels post the session, so you can listen in case you've missed out. What's your message for all our viewers out here?
So I would say that Tata AI offers quite varied products depending on your age profile, your risk profile, and your investment horizon. And we have demonstrated over the period that we have been generating superior return. So please look at our plans and invest. And overall, happy wealth creation. Invest in India. We are doing well amongst the emerging market countries. So happy wealth creation to all of you.
Absolutely. India is indeed the emerging market here. So please definitely invest. Santosh, some concluding remarks from your end to all our viewers listening to us.
I would say that invest, in a monthly fashion, invest for long term. Keep an objective in mind when you invest. You can compare products while you invest, and all kinds of products are available on Policybazaar.com. The other advantage of buying through Policybazaar is the fact that when you buy online, there's a specific discount that companies provide, and your maturity value will be higher when you buy online. Plus, you will be able to speak to experts who have helped customers generate a lot of wealth over a period of time, and they may be able to help you guide what is the right investment for you, what is the right amount of money you should invest, and for how long. So speaking to somebody and that information that you understand from those advisors are available on the website. So there is absolutely full transparency. You'll be able to see what you heard. So there is no chance of, I would say, any kind of misinformation being provided. You'll be fully aware of the product that you're investing in, how much, when will you get your money, and at the same time, I would say that when you are investing for a long term, talk to an advisor, may just help you understand and plan your portfolio better. And the last, I would say, advice would be always diversify your portfolio. So park your money in different asset classes, and you should be able to generate good wealth.
I also see a message by Lorna here. So to brief everyone, those of whom we have not been able to address, but they've mostly taken most questions, you can write into us on policybazaar@policybazaar.com, and we'll address all your queries. In case you have any questions on the Tata plans and details that Mr. Patil as well mentioned, you can please mention to us and we'll take it up, and you can come onto a platform and check out all the plans. Hope the session was fruitful and you all gained a lot from both the experts on the show today. Thank you everyone, and thank you Santosh and Mr. Patil for your precious time. Thank you for the time.